What if I told you the next stock market correction won't come from where most investors are looking? The US stock market has been making new highs, AI stocks are booming, and optimism is everywhere. But history shows us one thing very clearly. Corrections don't happen when people are scared. They happen when people feel safe. In today's video, I'll break down 3 major risks that could trigger a stock market correction in 2026. And more importantly, how smart investors are preparing for it right now. Let's get started. This video is not about fear or panic. It's about risk awareness. A correction doesn't mean a crash. A correction simply means a 10-20% pullback, something the market experiences regularly. If you understand the risks early, you don't lose money. You position yourself to win. Risk number 1. AI stock bubble and extreme valuations. What's happening? AI is transforming the world, and that part is real. But stock prices don't move on technology alone. They move on expectations. Many AI-related stocks are trading at extremely high PE ratios, massive future growth assumptions. Investors are pricing in perfect execution for the next 5 to 10 years. Why this is dangerous? When everyone believes a story, the risk increases. We've seen this before. Dot-com bubble, crypto hype, EV stock mania. The problem is not AI. The problem is overconfidence. What could trigger a correction? Earnings miss from a major AI company, slower enterprise AI spending, profit margins failing to meet expectations. When expectations are too high, even good news can crash a stock. Called smart investor mindset. Professionals don't ask, is AI real? They ask, how much of this future is already priced in? Risk number 2, interest rates, debt, and a slowing economy. The rate problem? The US economy has been living on cheap money for over a decade. That era is over. Even if rates come down slightly, they may stay higher for longer. Corporate refinancing becomes expensive. Consumer credit stress increases. Why debt matters in 2026? US government debt is at historic levels. Corporate debt is massive. Consumers are relying more on credit cards, buy now, pay later, auto loans. High debt plus high rates. Pressure. How this hits stocks. Lower corporate profits, reduced consumer spending, slower economic growth. Stock markets don't crash when the economy collapses. They correct when growth expectations change. Hidden danger. The market is currently pricing in soft landing, rate cuts, strong earnings. If even one of these assumptions breaks, volatility returns fast. Risk number 3. Geopolitics and global shocks. The global risk factor. Markets hate uncertainty, and uncertainty is rising. Potential triggers: US-China tensions, Middle East conflicts, trade wars, election-related instability, supply chain disruptions. Well, why 2026 is sensitive? By 2026, markets may already be stretched. When valuations are high, small global shocks, big market reactions, algorithms amplify selling, liquidity dries up quickly. Modern market reality? Today's markets move faster than ever. High-frequency trading, AI-driven algorithms, passive investing dominance. Fear spreads faster than fundamentals. How smart investors prepare. The goal is not to predict the correction. The goal is to survive it and profit from it. Smart strategies include diversification across sectors, holding some cash for opportunities, focusing on quality companies, avoiding hype-driven trades, thinking long-term, not emotional. Corrections don't destroy wealth. Panic does. Let me leave you with this. Every major correction in history felt unexpected. But the warning signs were always there. 2026 may not bring a crash, but ignoring these risks could be costly. If you want to stay ahead of the 99%, don't ask, will the market fall? Ask, am I prepared if it does? If you found value in this video, hit the like button. Subscribe for real market insights. No hype, no fear. Comment below which risk concerns you the most.